friend. I love the fuchsia there with the blue. It looks really good. Talk about excellent color. Mike Baudendistel is with us here, our intermodal expert and CPG and author of and host of The Stock Out. What's going on today there, Mr. Baudendistel?
Hey, not much. How are you guys?
So good, Mike. So good.
Doing great, doing great. So let's talk about the issue at hand here. Hub Group, what's going on there? Do they make money?
Yeah, I mean, their shares have been strong the last few days. They've gained back a portion of what it lost earlier in the year. So last 5 trading days, up about 11%, still down for the year, sort of year to date. But they reported last Thursday, and company reported pricing and renewals in the mid to high teens, which I think was maybe a little bit of a surprise to the upside, and maybe also a surprise to the upside is they said they've seen more truck to rail conversions than they've seen in several years. I mean, some of the customers are going back to intermodal after having used the highway, during the period of time when rail service was substandard, over the past year or so. So it does seem like rail service has improved to the point where more customers are looking at that as an option. Maybe there's less time sensitive nature in some of those loads. They did talk about maybe the China lockdowns as being maybe the primary, risk to volumes, going forward. So I thought that was interesting. Also got a couple of interesting questions on intermodal from Sonar customers yesterday. One of those was related to the upcoming, potential for labor disruption with the ILWU, and if we're already seeing a shift in volume away from the West Coast ports. And so I brought up the O-rail volume. We have intermodal volume, on a granular level. We can sort it any way you want to do it. But, the way I did it was combining, if you combine the international and domestic containers and just look at that outbound from the major port cities, what you see is all the West Coast, ports, their intermodal volume is down year over year, anywhere from 5 to 20%. LA Long Beach is down 9%. And then you look at the East Coast ports, and those are up for the most part. Elizabeth up 6%, Norfolk up 25%, Charleston up 80%. So it does seem to be a pattern, there already. Maybe that's not entirely due to the, outlook for labor, but this person's thesis is that we're going to see a pretty significant shift from the West Coast ports to the East Coast ports, which could be a negative for overall intermodal volume because the volume that comes in through the East Coast, most of that gets trucked. Let's say 20 to 25% of it gets moved intermodal, whereas coming on the West Coast, it's about 70% intermodal just because the consumption primarily happens in the East. So I thought that was an interesting question we got from a Sonar customer. And another interesting question we got from a Sonar customer on intermodal yesterday was related to the spread between intermodal spot rates. We have a national average for intermodal spot rates and a national average for intermodal contract rates. And this person pointed out that there's about a 60-cent spread still with spot rates being higher. Whereas if you contrast that with domestic truckload, as you guys have talked about, that spread has collapsed. And actually the contract rates are a little bit higher if you include fuel surcharge. And sort of what's different about domestic intermodal versus domestic truckload. And, my response is really it's so varied on domestic truckload by lane, where there's some lanes where the railroads have priced the spot rates in such a way as to not encourage incremental shipments and to protect that capacity for contracted, shippers. For instance, Chicago to Atlanta showing a per rate mile 390. That's higher not only what I presume to be the contract rate in that lane, but even the truckload rate, which is 311 based on our Sonar market dashboard tool. So we do have some lanes like that are bringing up the average spot rate. So that was a good question as well.
It is. I like to look at that. In fact, I was looking at it this morning. Is that savings on the contract over truckload, and that spread has. it's really starting to contract a little bit with contract rates coming down a little bit, but it doesn't seem to. I still see the volume on rail overall national versus the truckload volume. That gator mouth is still spreading. Now, when we start talking about moving in with the China situation that is there, and we're a ways out from seeing that ripple kind of come across the Pacific and hit us. But is there a concern there to losing volume again out to the truckload as urgency may peak again once we go through this kind of dry spell? There's that urgency to pull things forward and trying to get things through the ports and to the consumption centers?
Yeah, I think the concern is that some of those goods are just going to be delayed. So things that, maybe are, you think would take place and come across in the summer are going to be in a crunch for back to school, or just they're going to miss their time deadlines of when those goods are needed, which creates more time urgency, which makes more, truckload the only option, and intermodal is too slow. So that is certainly a risk, I think, to intermodal volume.
And as we move forward, Michael, is anybody talking about, or is there giving thought to the long-term effects of what is going on here? I mean, assuming we get through this, right, and when things go back to some sort of normalcy, we've had a lot of ports that have been dredged out and widening, and infrastructure improvements on the East Coast, and you see the infrastructure investments from the current administration, and it seems to be going into Texas and East Coast and that sort of thing to improve capacity. That changes obviously keeps some of that change in capacity and where it comes, or volumes and where they come into the United States, it remains sticky. Is that of any concern to the rails and intermodal or operators, and is there any reaction to that?
Yeah, certainly it's a concern. And I think that's still a long-term trend. I think the long-term trend is more goods coming in through the East Coast ports because of all those investments that you mentioned, and just because the per mile cost to ship something on the water is way less than what it is on the surface. And so the more economical way to do it is all water route to the East Coast. As far as the reaction of the railroads, I mean, we have seen a lot of investments by Burlington Northern and J.B. Hunt, which collaborate on that LA to Chicago corridor. The J.B. Hunt's going to take delivery of about 40,000 incremental containers in the next 3 to 5 years. And what goes along with that is Burlington Northern is making a lot of investments in and around rail terminals. So they're doing what they can to improve the service in that corridor. My concern would be that just the cost of doing business in California and dealing with the unions and at the ports, all of those things are problematic.
Yeah, there's a lot of items that are issues, hurdles out there that promote going to the East Coast as your port of entry into the United States as we move forward. Anything else out there that you're working on with CPG or the stock out?
Yeah, just did a CPG podcast yesterday, and I think kind of the quick summary is that the CPG companies that are limiting their price increases to, let's say, 4 or 5% year over year, they're actually seeing volumes hang in there. I mean, a lot of those companies are still seeing volume growth, even after raising prices, kind of mid-single digits. The ones that have been more aggressive, like Unilever, took their prices up over 8%. They are seeing some volume declines and some losing some conquest sales to other brands. So there is some impact, some evidence that there is some degree of elasticity even with CPG. It's not as bad as what you see with things that are truly more discretionary in nature. And then on the freight side, the CPGs are still talking about freight costs as being headwinds for 2022, and still the contracts that are still renewing at higher rates than they were last year. So even with all the concern that we have with going to be a trucking bloodbath, it's not immediately translating to lower freight costs from the perspective of the CPG companies. That may come, but for their immediate outlook, it's still a headwind.
Yep, excellent stuff. Thank you so much, Michael. Hey, check his stuff out, the Stock Out newsletter, the show, and you're going to be on Loaded and Rolling later on today, I believe, with Thomas Wasson. So check him out there. Always interesting, always informative. Thank you so much, Michael.
Hey, good to see you.